Okay, first of all, private equity hedge funds are colossal now. Some people call them a shadow banking system, and they were the real inside story of the financial crisis of 2008 and 2009. A lot of these private equity hedge funds had massive payments from the financial institutions that failed due to various types of speculations. But let's talk about how they're structured. Let's take a private equity firm, for instance. Today, most private equity funds, again, a firm may have several funds, most of their investors are public pensions. So when it comes to sharing profits, the way it looks, generally speaking, is the public pensions get all these profits here. Okay, they get all these profits, we'll call them the blue chips. And the partners, the general partners, such as Blackstone, they get their share. Well, maybe I'll add another couple chips here, but it's pretty small because they generally don't put more than 5% of their own funds in these partnerships. The big investors are Cal PERS, Oregon PERS, Virginia PERS. Okay, so that's how they split the profits. Okay, and then the question becomes, well, you know, in partnerships you split the profits and the tax deductions equally. Okay, so then we go to splitting the tax deductions. So the private equity partners, they take their share of the tax deductions, and the public pensions take their share of the tax deductions. Okay, now ask yourself, what can these public pensions do with these tax deductions over here that are allocated to them because they own 95% of the fund? Nothing, because they're tax exempt. So the game has become, based on my analysis, these general partners are using the large public accounting firms, the Final Four, Deloitte, Ernst & Young, PricewaterhouseCoopers, and fourth one's not coming to mind. But they're using these firms doing aggressive transfer pricing, all kinds of allocations and accounting tricks to move these tax deductions back over here to the general partners of the private equity fund. Now ask yourself, if this is your profits right here, and these are your tax deductions, are you ever going to pay any tax? Probably not. So the Obama administration is all caught up in this argument about whether or not these private equity partners should be taxed at ordinary versus capital gain rates. Currently they're taxed at about 15%, and the assumption is they'd be taxed around 30% if they were taxed like anyone else. A plumber pays ordinary taxes, a physician, a teacher, a doctor. Why on earth would these people say we should get capital gains taxes when they're not even investing their own money? They're investing public pension money for the most part. But look at the size of these tax deductions. Let me stack them up a little higher. Okay, if this is your income and these are your tax deductions, are you ever going to pay any tax? Of course not. And so this is the big untold story based on my analysis of these private equity and hedge funds. They're tax deduction pyramid schemes, just like in the 1980s with real estate limited partnerships. You might think, well, how about these public pension investors? What are they doing in terms of oversight of these private equity hedge funds? Let me read something to you from Oregon State Treasurer Ted Wheeler's office, dated September 13th, 2011. Basically, I made a public records request, and I just asked them. I have many clients who are participants at PERS, and I said, can you just send me a breakdown of the total carried interest fees paid for the last 3 years for each of your partnerships? And they've got about $10 billion in private equity funds. It says, reported figures from their annual report regarding fees do not include carried interest payments or transaction fees. And again, that's why I asked for them, because these carried interest payments are 10 times generally the management fees. Because these payments are accounted for as internal transactions of the partnerships. The Treasury maintains no independent records of such information. Think about that. So let's say Oregon State Treasury has $10 billion they invest with these private equity hedge funds. And they don't even, and these private equity hedge funds, they make 20% of a certain threshold. We're talking about hundreds of millions of dollars, billions of dollars. And the Oregon State Treasury doesn't even get an independent accounting of the fees that they're paying, the carried interest fees in each of the partnerships. That's astonishing. I mean, as a former CPA, I find that absolutely astonishing. And then that kind of speaks to what Eric Cantor's comment was in Bloomberg, dated September 12th, when he said, even though he doesn't see they should be taxed as ordinary income, the carried interest, he wouldn't object to changes that tighten restrictions on illegitimate uses of carried interest deductions. Well, what exactly are those illegitimate uses of carried interest deductions? Well, I think what he's talking about is that these tax deductions they're taking. They've set up these schemes through transfer pricing, so they're moving all these non-usable tax deductions from these public pension investors. The game is to try and move as much of these tax deductions over to them as they can, and then they traffic in these. They traffic in them, just like you've got drug traffickers, you've got tax deduction traffickers, you know. That may seem like an extreme example, but consider this. In the recent financial crisis, this is according to the OECD, a very reputable international organization that keeps track of financial information. They estimate that there's $700 billion in bank losses being trafficked. Okay. So here's an example how you traffic losses. Okay. Let's say I'm sitting on all these losses here and I say, well, I might say, gee, Bob, tell you what, I've got $100 million worth of losses here, tax losses. They're real valuable. I'll sell them to you for $5 million. Okay. So Bob over here just accumulates lots of losses. He's accumulating hundreds of millions, billions of dollars worth of losses. And then Bob thinks, well, wait a minute. Now we can take this huge pool of losses and let's go out and buy some companies. Let's buy some quality companies that pay good wages, good benefits, pay a good dividend to their stockholders. Let's buy some of those, and we're paying a lot of tax, of course. You know, take a company like a big company like Caterpillar. You know, Caterpillar, their effective tax rate is like 27%. What if they could take that huge cost of doing business, one of the biggest cost taxes, and reduce it to zero? Well, let's say they could buy Caterpillar. This is what it costs them to buy Caterpillar. Okay, they roll in Caterpillar, they offset their tax deductions against their income, and they effectively convert them to a nonprofit without anyone knowing it. And then what they do is they lower their prices, drive the competitors out of the market, raise the prices, and then you've got some significant antitrust issues. So the question becomes, how have these private equity firms been allowed to grow so explosively with almost no oversight? Well, the reason is they're up till now there's been no oversight by the Securities Exchange Commission, but that all changes as of March 31st, 2012 as part of the Volcker reforms, and that they have to disclose minimal things about their businesses. And one of the things that you might find curious is that they evaluate the investments themselves. So for instance, if I were running a private equity firm, I pretty much determine what the value of all the various investments are in my fund, which is kind of astonishing. Now they'll say, well, we have accounting firms review it, et cetera, et cetera. But to make a long story short, for the most part, these guys are valuing the investments in their funds themselves, self-evaluation. Okay. What I think is basically, back when Charles Keating was destabilized the whole savings and loan system, and there was the famous Keating Five, which included John Glenn, a prominent Democrat, famous astronaut, guy of integrity, and John McCain, another person of integrity on the Republican side. They both got swept in it, and it really disabled their political careers. What I think we have today is what I call the Schwarzman 8. Steve Schwarzman is the CEO of Blackstone, the largest private equity firm, the most aggressive. He's the one that called Obama a Nazi because Obama wanted to tax his income as ordinary income rather than capital gain. Okay, so I'm going to explain who I think Schwarzman 8 are, why I've included them, and in the process explain some of the other dynamics with respect to this situation. And again, I think we're really close to resolving this because all it takes is a little bit of disclosure, public dialogue, and then the thing gets fixed. Okay, the first one of the Schwarzman 8 would be Bill Clinton. Now, it may surprise you, but Clinton's a Democrat, and the reason is Clinton is in partnership with Ron Burkle, and they do takeovers. His foundation may have jobs initiatives, trying to create new jobs, but let me give you one example. Bill Clinton made millions of dollars in the hostile takeover of Wild Oats. Wild Oats was a very promising young grocery chain competing with Whole Foods. And Whole Foods didn't like the competition, so they did a hostile takeover backed by Burkle, liquidated them. A lot of great jobs were lost, the middle management jobs, the types of better paying jobs that really make a difference. So that's why I would include Bill Clinton. The second, another former president, George Bush Sr. George Bush Sr. has been very closely aligned with the Carlyle Group for a long time, and Carlyle Group's whole business is buyouts. You know, they go in, they buy up companies, strip out all the assets, use massive tax deductions to convert them to non-tax entities, drive competitors from the market because, again, a lot of times their companies aren't paying any taxes because they've got these schemes going. So I'd include George Bush Sr. as the second. The third would be Bill Gates. Bill Gates, according to Forbes, is worth $60 billion now. His net worth just keeps going up. And the reason it's going up is not because of Microsoft stock, because Microsoft stock's been in a free fall for a long time. The reason his assets have increased so greatly is because he's a big investor in hedge funds and private equity. Okay. So again, he may have this foundation that's doing a lot of great work. But if you're really concerned about job creation, you got to talk about what's the impact of these buyouts that are just decimating the job base, in particular higher quality middle management jobs. Buyouts that make no economic sense and may indeed be driven by a tax deduction pyramid scheme. Because if these partners in these private equity firms can take this amount of income and through creative accounting move this amount of tax deductions over to it, what do they care whether the companies are profitable? They're getting massive cash flow. The fourth person I'd include is Tony Blair. The reason Tony Blair is included, Labour Party, former Prime Minister from the UK, he's a private equity person now. He's involved in a private equity fund. Well, how is it that these former presidents and prime ministers get involved in private equity funds? I mean, have they no dignity at all? You know? And at the same time, they talk about the global economy and trying to do all these good things to turn things around, and here they are involved in a job destruction machine that, again, may be driven by non-compliance with existing tax code. Okay. The fifth person I'd include is Eric Cantor. Cantor is the Republican Speaker of the House. What he doesn't like to talk about is that his wife is chair of the Virginia Public Pension System. Okay. $60 billion in assets, $10 billion of which is private equity and hedge funds, and she's also a partner in a private equity fund. So the fascinating thing about Cantor is their family income is most likely carried interest. And here he is leading the debate saying, no, we can't tax carried interest for what it really is, ordinary income. We have to give it a special capital gain tax rate, which is less than half of what everyone else is paying. So I would include him. The sixth, of course, who must be included is Robert Rubin. And Robert Rubin is the godfather of hedge funds. Bloomberg Markets did a cover story in 2000, A Tale of Two Cities. Sandy Weil told one tale, and I told the other. And the rest is history. Here's a look at that. It was a cover story in Bloomberg Markets, their best publication. The seventh person that clearly needs to be included in the Schwarzman 8 is current Treasury Secretary Tim Geithner. I mean, he may be a very fine person, but why Obama didn't fire him day one is a remarkable mystery, because Geithner is literally an errand boy for these private equity people. When he was president of the New York Federal Reserve, the chair of the New York Federal Reserve, the chairman of the board was a big private equity guy. He ultimately resigned when things started unraveling because it was real clear there were some massive conflicts of interest. So Geithner clearly has to be included. And the last person who might surprise you also, that this I would find as the Schwarzman 8, would be Charles Schwab. Charles Schwab was a great innovator. He kind of invented discount brokerage commissions. He ran out of Texas and went to California. The rest is history. But you know, he's done a real flip-flop. Charles Schwab has. Just this last week, there was an article. Charles Schwab bashes Buffett rule, Obama policies. Putting Obama's policies aside, Charles Schwab is ardently opposed to people people make over $1 million pay ordinary income rates. He's ardently opposed to that. These private equity hedge fund investors, oh, we can't be doing that. Well, what he doesn't tell you is that Charles Schwab, his company, is involved in a massive scheme regarding private equity and hedge funds. And here's how the scheme works. Let's say I invest a couple $1 million in a hedge fund. I'll choose a locally based one, Common Sense hedge fund, based here in Portland, Oregon. Maybe a fine hedge fund, but okay, it's a hedge fund. Okay, I put $2 million in that, and that's not a publicly traded security, but Schwab allows that investment to be shown on my statement. So when I look at my Charles Schwab statement, I see this unregulated hedge fund, which basically, you know, values things themselves on the statement, and the next line might be a high-quality company like Intel. And so investors they're not distinguishing between these publicly traded companies that have a lot of oversight and these private equity hedge funds that are not that have no market, basically. So Charles Schwab earns fees from that. And in my mind, that's a massive scheme. I mean, think of all the investors out there who look at their statements and they have no idea what the real value of these private equity and hedge fund interests are. Believe me, if they didn't get that on their Charles Schwab statement, they would think about it differently. So Schwab shouldn't be doing that, and they do. So I think that's a key part of the scheme. So again, those are the Schwarzman 8. Bill Clinton, George Bush Sr., Bill Gates, Tony Blair, Eric Cantor, Robert Rubin, Tim Geithner, and Charles Schwab. And just like there were the Keating 5, I think that when people look back 20 years from now and they say, how did this private equity hedge fund phenomenon occur? What allowed this tax deduction scheme to proliferate? It'll be those 8 people.